Simple moving averages can be used to determine the trend, but as it is a lagging indicator, it does not provide early signals. So the exponential moving average EMA was created to reduce the lagging of the SMA. The exponentially weighted moving average reacts more significantly to recent price changes than the SMA by placing greater weight on the most recent price behavior. Therefore, compared to SMA, the EMA is more responsive to the current trend. Let's take the Euro to US dollar daily chart from August to December 2018 as an example. The purple-colored line represents the 30-day SMA, while the gold represents 30-day EMA. As shown in the chart, the 30-day EMA line moves along the trend and is more sensitive to price changes. The famous Australian trader Darryl Guppy combined two groups of MAs with different time periods to create the Guppy multiple moving average strategy.
If you want to watch the full version of the video, you can go to TradingLive or download the TradingLive app. Share it to your friends and learn for free.